Hey everyone, welcome back to the channel, which is all about income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds to reach financial freedom as soon as possible. Very excited about today's video because we are going to take a look at a brand new ETF from one of my favorite ETF providers, Hamilton ETFs. Of course, I'm talking about HMAX, the Hamilton Canadian Financials Yield Maximizer ETF. Yield Maximizer, guys, that's actually in the name. Very exciting. It always perks my ears up when I see that. So what is this ETF all about, everyone? There are many Canadian financials covered call ETFs out there. So what makes this one different? What makes it so that it's going to have such a high yield of over 13%? That's right, over 13% yield. How is that possible? Let's do a deep dive on this ETF right now. All right, everyone. So as usual, we go straight to the official ETF provider's website to get all the information we need about this ETF. So I am on Hamilton ETF's website, and we're going to take a look at HMAX. Hamilton has a really very nice website where you could see everything. So first thing we'll see is right here, the highlights for investors and the fund objectives. So let's go through it. 13% plus target yield. So right off the bat, very high yield, monthly distributions. And right here you have it, a highest yielding financials ETF in Canada. I mean, 13+% yield, that's for sure. So this is going to be a diversified financials, not just the 6 banks. So it's going to have exposure to Canada's 10 largest financial companies with about 75% of it in the big 6 banks. So we'll take a look at the actual stocks together in a second here. And of course, we have an active covered call strategy to enhance the monthly income and reduce volatility. And you see here that current coverage is about 50%. So they're writing covered calls on approximately 50% of the portfolio right now. So this is a good fit for investors who want higher monthly income, of course, blue chip Canadian banks and financials exposure, tax efficient distributions. Of course, when we're doing covered calls, the premiums we get are capital gains income. So in case you're holding this in a non-registered account, you are getting tax efficient distributions because they are capital gains distributions rather than interest, for example, which is what a GIC would give you, or bonds. And of course, reduce volatility from option strategy. So whenever you're putting covered calls on something, everyone, you're actually reducing the volatility, you're reducing your risk. So that's pretty standard here. Fund objective. This is very interesting. Of course, this is very key. What is the goal of this fund? It's designed for attractive monthly income while providing exposure to a market cap weighted portfolio. Market cap weighted means the bigger the company is, the more of a percentage it's going to be. And we're going to take a look at that in a second. Canadian financial services stocks. So to reduce volatility and of course increase or augment the dividend income, HMAX will employ an active covered call strategy, which we will look into as well. And one thing to note is, unlike HYLD, HDIV, or their other enhanced ETFs like HCAL, HMAX does not use leverage. So first question I had was, how is it possible they're getting such a big yield? Well, we're going to find out in a second here. So if we scroll down, and they explain it right here. Again, really nice website, tells you everything you need to know. What makes it different? Well, many covered call ETFs write options on about 30 to 50% of the portfolio out of the money, right? Out of the money calls. They're talking about the moneyness of the covered calls here. So HMAX is able to provide higher monthly income with a dynamic covered call strategy, currently writing options on approximately 50% of the portfolio at the money. So there is really the big difference between, say, this ETF and a ZWB. So ZWB, which is the biggest and most popular covered call Canadian 6 banks ETF in Canada, writes on approximately 50% of the portfolio, but they're out of the money call option. So what makes HMAX different is they're writing on approximately 50% of the portfolio at the money. So these are more aggressive calls, which means you're generating much higher premiums. So that's what it says, right? This allows HMAX to generate higher premiums while maintaining 50% upside potential, which makes sense, right? If you're only writing on 50% of the portfolio, the other half fully participates in the growth of the stock. So you have the averages here. You could see that, if you would just own the big 6 banks, generically just the six stocks together, you get about just under 5% yield. If you would get a typical Canadian bank covered call ETF, this is the average of ZWB, That's from BMO, CIC from CI, and BKCC from Horizons ETF. So the average yield of those three is 7.81. So with HMAX, you're getting approximately double, guys. This is very, very surprising even to me. That just goes to show you how, writing options, covered call options at the money is generates a lot more premium than out of the money. But it's still 50% of the portfolio. So you're still going to participate in the upside, but only half, right? 50% of the upside. And another thing you need to notice here is it's a dynamic covered call strategy. And I did speak with Hamilton ETFs yesterday, so I kind of got an inside scoop on this. Dynamic means it's, unlike BMO strategy where it's really set in stone, they're able to play around with the covered call strategy or the moneyness or the of the options and the portfolio coverage of the options. So basically what this means is, let's say we're in a period of higher volatility, and to make 13% plus yield, they don't even have to write on 50% of the portfolio. They could write it on less. They will actually do that, right? So that's, I personally prefer a dynamic covered call strategy opposed to a systematic or one that's set in stone. But that's just my opinion. So that is basically how they will generate that 13+% yield. No leverage, right? This is another thing that's, kind of an advantage. I mean, not many people like leverage or buying leverage ETFs. There's no leverage here. It's just the covered calls they are at the money instead of out of the money. So if we look at the, if you look at distributions, obviously the first one is going to come out or is going to be paid out in March 10th, which is usually Hamilton ETFs pays out all their distributions on all their funds about on the 10th of every month. So the first dividend is going to be declared at the end of February. And you see here the estimated one is 18.5. So 18.5 cents is going to be the approximate monthly dividend. So if we just do a quick calculation right now the price is at 16.10. So if it's 18.5, you do times 12 for the annual rate, right? You need the annual rate whenever you're calculating your yield. So that's $2.22 a share. To figure out the yield based on, let's say you buy HMAX right now at 16.10, you just do divided by 16.10 times 100. So you see that your yield will be just under 14%. So they say 13 plus, but it's actually very close to 14. So it's no surprise. It doesn't take, you could clearly see, guys, that this is very, very attractive and high yield, a dream come true for income investors like myself. And it literally says it in the name, right? Yield maximizer. So obviously the primary objective of this ETF is yield. And I did speak to Hamilton ETFs about it. They are always wanting to target a teen yield. So teenager yield. So it's always going to be about 13%. Is it always going to be exactly 13 or 14 or 12? Well, it could vary, but knowing Hamilton ETFs and looking at their other funds, they're very, very consistent with their distributions. If we look at HDIV or HCAL, and sometimes they are growing their distributions as well. So I would expect that HMAX is going to be no different. It's going to be probably, my opinion here, a consistent high 13% yield, which is absolutely incredible for a non-leveraged fund. So very, very exciting, guys. So what is actually in this ETF? We got to look at what's inside. So we click on overview and we see the breakdown right here. So this, like it said before, like we saw, it's market cap weighted, which means the bigger companies, in this case Royal Bank and TD, which are the two biggest financials in Canada, are going to make up the bigger portion of the fund. And Hamilton ETFs did mention that this actually helps with the covered calls, with writing the options, because the bigger the company is, the deeper the market is for the option. So this actually helps. And to be honest, I kind of like this. I rather think of this more like an index weighted, where the bigger companies have the bigger portion. I kind of like this. So Royal Bank and TD, the two big guys here, at over 20% weighting. So basically 43% of this fund, guys, is pretty much Royal Bank of Canada and TD Bank, the two biggest banks in Canada. And you got the other ones too, of course, BMO, BNS. You also have Brookfield. So Brookfield Corp is the biggest asset manager in Canada. Keep in mind, guys, these are the top 10 financials in Canada. So it's not only the banks, but the 6 banks make up the majority of this ETF, about 75%. So you have all the banks, you have Brookfield Corporation, which is your asset management here, percentage at 9.7. But you also have 15% in insurance. And of course, Manulife, Sun Life are the two biggest ones. So here they are right here. And they also added Intact Financial. So you got the 6 banks, you got the 3 biggest insurance companies, Manulife, Sun Life, Intact, and you got the biggest asset manager, Brookfield Corp. So the top 10 biggest financials in Canada. Big, boring blue chip dividend paying stocks, guys. So very nice mix here, which gives you a little bit of diversification. Whereas if you would go with a ZWB, it's only the 6 banks. So a little bit more diversification, but definitely the majority is skewed towards the 6 banks as well. So the management fee is 0.65%. Very competitive, on par with ZWB, pretty much the same thing. And I did ask them what the approximate MER is going to be, although that's not published right now. It's going to be about 0.80, so about 80 basis points MER. So yeah, very interesting fund here, guys. The main takeaway, or what I really want you to understand, is very high yield because they are writing at the money calls, but it's only on 50% of the portfolio. So you do have some upside, but keep in mind, like the name says, this is really a yield maximizer ETF. And another thing to remember is, this ETF, the distributions will, and there is a big possibility, or they pretty much will increase if the Canadian banks keep increasing their dividends, because don't forget that it's not just covered calls that's giving you this 13% plus yield. It's also the dividends from the actual companies. And they, if you look at the Big 6 average, you're looking at almost 5%. So one of the components of this 13% plus yield is going to be the actual dividends of the companies. And as we know, the Big 6 banks, the insurance companies, raise their dividends over time. So just like the HCAL ETF, I do expect that the distributions will go up over time. So very exciting. So you're going to get, a lot of income, but you will get growth as well, and dividend growth. So this is very interesting, guys. Very unique ETF here. If we just compare real quick to ZWB is the BMO covered call Canadians Bank ETF. It's the biggest and most popular covered call Canadian banks ETF with almost $3 billion in assets. And you see that the yield is right about half of what HMAX is offering. So the yield is about 6.93%. This is actually based on January 13th. So it's actually a bit lower now. It's about 6.88 or something like that. So HMAX is basically double the yield, which is absolutely incredible. So if you're interested in owning the best Canadian financials, 75% of which are the Big 6 banks, which of course are pretty much the best, or continue to be some of the best stocks in Canada. They always outperform the overall Canadian stock market. You want a lot of yield. This ETF is an extremely attractive option right now if yield and maximizing your income, like me, is your top priority. You can check out the fact sheet as well. So, the fact sheet pretty much tells you exactly what we discussed here. So the current coverage ratio is 50%. Covered calls at the money. So don't forget that this is a dynamic approach. So they're able to, play around with it. And I did speak to Hamilton ETFs. They said that their goal is really to maintain that yield, that high yield of about 13%. But since they have a dynamic covered call approach, they're able to play with that, which I like. I like it better than a systematic approach. So you might be wondering who's managing these covered calls for Hamilton ETF. So if you scroll down, you could actually see that the administrator is Horizon. So I did confirm that the Horizons portfolio manager, the guy who manages the covered call ETFs at Horizons, will be managing and writing the calls for HMAX. So in case you missed it, I did actually have an interview with Nick Picard. So Nick Picard is the guy who's actually going to be working on or writing the calls for HMAX. Super nice guy. I really like him. He has a background in mathematics, and that's exactly who I want my covered call guy to, that's the background I want him to have. So if you want to check out this Q&A I did with Nick a few months ago for the Horizons ETFs, you could check it out. I'll put the link to the video description below as well. So he's the guy. Horizons is actually who's partnering up with Hamilton to actually write the call. So very exciting, guys. It just came out. This ETF just came out here. and it's looking to be definitely the highest yielding Canadian financials ETF. Once again, Hamilton came out with a really cool and unique, very high yield ETF, which if you're looking to get into the six banks or the Canadian financials and you want to maximize your yield, you don't really like leverage, this is definitely the ETF. Hey, don't go yet. I have some important reminders, including some more recent ones, and I'll try to keep it as brief as possible. And for everything that I'm about to discuss, the links and info are in the video description below. So first of all, if you didn't know yet, I do offer a one-on-one coaching session where you'll have a 1-hour Zoom call with me where you could ask me all the questions you want, and I'll help you and assist you best I can. Just remember that I'm not a licensed or registered financial advisor or planner. So to book a session, go on my website, passiveincomeinvesting.ca, and right there on the homepage on the left-hand side, there is a small video. Watch that video to know how to book a one-on-one properly with yours truly. Also on my website, you could purchase my digital product, the Ultimate DIY Investing Package, which is on version 4 right now. It comes with lifetime updates, so you only have to buy it once. And this is really a reference tool or a companion tool to help you build your own portfolio according to your needs and your objectives. It has lists of funds. It has sample portfolios for both Canadian investors and American investors. So make sure to check it out on my website. I actually created a video which shows the product from A to Z because I don't want you to spend money unless you know exactly what you're getting. So make sure to check that video out on my website. And don't take my word for how good it is. Check out the reviews. There's over 300 of them, and they are all 100% real reviews. So here's some more updated news or recent news. I am now on Blossom, a new investing app designed for investors. I've been using it for a few weeks now. I think it's really, really great. It has a really cool feature where users could actually add and share their portfolios and what they're buying and selling every day. So you could actually link your investing account so it's updated automatically on a daily basis. I recently added my own main portfolio so you could follow how my portfolio is doing live and what I buy every month. Really, really cool. It's like a mix of Facebook and Twitter, but specifically for investing. So get on your phone, click on the link in the video description below and download the app. It's 100% free, so you too could share your portfolio. Just remember to look for me and follow me. My username is Adrian, PII altogether. Also, I do have a referral link for Questrade, so you could get $50 worth of free stock purchases. This is the Canadian discount broker that I use and I recommend. Unlike Wealthsimple, the other popular discount broker in Canada, you could drip everything you want. It has all the stocks and it also has dual currency accounts. Very, very convenient if you're buying both Canadian stocks and American stocks. I have a Questrade video, by the way, which gives you a little tour of the features, so make sure to check that out. I also have a referral link for PASSIV. This is the portfolio tracking tool that I use to consolidate all our accounts to get a nice bird's eye view, so you can consolidate all the information together for easy tracking and stats as well. Also, our Facebook group, Passive Income Investing, is now an invite-only private group. So to join it, you need to click on the link in the video description below and give the group a like to get invited. So we take pride in making this one of the best investing Facebook groups out there with over 13,000 members. There's no scams, there's no spammers, and negative and doomsday people, we kick them out right away. Also, follow us on Instagram if you want a little bit more of our personal journey here in Panama. And lastly, just remember everyone, I am not a licensed or registered financial advisor. This channel is all about my personal investing journey and how I invest to generate high passive income from a diversified portfolio of high yield funds. It's for educational purposes only, so don't forget to do your own research and due diligence. And of course, stay safe everyone, stay healthy, and of course, stay passive. See you next time.